Hey everyone, it's Hamish from the Young Investors Podcast. Myself and Brandon are excited to bring you your weekly rundown of the latest business and investing news from around the world. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing, make sure you reach out to a qualified financial advisor. But with that said, let's get into another episode of the Young Investors Podcast.
Hello, everybody.
Hello.
Hello, Hamish.
What are you doing in my house?
So true. You got to go over to YouTube and watch these ones on YouTube. It's a bit more, I don't know, it's just like a little bit more unhinged when we're actually in person together.
Yeah, no, it's great. But seriously, what are you doing? Brandon just shows up unannounced.
Sorry, mate. I'm here for the meet and greet. Is it here?
The meet and greet.
I told everyone it was at your house.
You posted my address on your public Instagram.
That's correct.
Fair
no,
enough.
there's like 100 people outside.
God, is that what that noise is?
No. How you doing, mate?
I'm doing well. Yeah, I'm excited. We've got a few little different things going on this week, which has been kind of exciting. Of course, this will probably go out after the meet and greet. So it was lovely to meet all of you.
Actually though. We should probably post. We'll post something today on the Young Investors feed as well, just a community post. Yeah. Oh, we can't really post anything on Spotify though.
No, not on Spotify.
No, but that's
unfortunately.
Okay.
No.
So hopefully you subscribe to the YouTube thing.
Yeah.
And you've posted on YouTube, on Instagram. I've posted on YouTube and Instagram. So hopefully everybody's heard about it. But
hopefully someone comes to my birthday.
But preemptively, yes, it was nice to meet everybody.
Yeah. And then we've got to get, can we talk about the other thing or not really? Probably not actually.
We probably next week.
Can. Next week. We've been saying this a little bit for a while.
But now it's actually really close.
Now we've almost checked all the boxes, and then we can talk about it. Yeah. But there is some other exciting thing that we're doing this week.
Well, yes, we will be able to announce it next week.
Okay.
Yeah,
next week,
because that next week's episode will be the start of.
The thing
that
you guys don't know about yet.
So how's that for a tease? All right, Hamish, what are we talking about today? What have you got?
We've got it's a bit of a start of earnings season, so we've got a couple of companies that we like to follow, and I'm sure a lot of people like to follow Netflix and Tesla, who are usually some of the tech or more widely followed companies that start to report earlier before over the next couple of weeks we'll see more of Meta and Alphabet and that sort of thing. So we'll talk through those earnings. We've got an update on UK inflation. Unfortunately, it's not good news. We've had some good news in the US and a little bit in Australia. Unfortunately, UK, we do not have good news yet. What else have we got?
I'm going to talk through Tesla earnings. I'm also going to talk about Apple. Tim Cook flew over to India during the week to open the first two Apple stores in India.
Wow!
So they're
moving into that market. Yep. Interesting.
Yep. Yes, and there's a couple of prongs to that strategy as well, which I'm going to talk about, which I think is quite interesting.
Fascinating.
Very big market.
Awesome. And then we'll try and get to a couple of your questions as always. Yes. And of course, if you have any questions for next week, you can leave them. If you're in Spotify, you can leave them natively in Spotify. Just scroll up. Or if you're listening or watching anywhere else, head over to the YouTube version of the podcast, hit subscribe. And also you can leave your comments on the latest episode. Leave your questions as comments on the latest episode. So
epic. All right, should we get going?
Yeah, with that said, today's episode is sponsored by Sharesight, which is an application you can use to track the performance of your stock portfolio. So you can bring in all of your trades either automatically by connecting your broker to Sharesight, or you can do it using Excel or one by one, however you want to import your trades from different brokers. And once you do that, it will track all the gains and losses in your portfolio. So capital gains, dividends. If you have dividend reinvestment plans, it will do all of those calculations for you. Currency gains, if you're buying shares internationally or you hold foreign currencies. And then you can also use it for when it comes to tax time. So Sharesight generates up to 12 different reports that can be used at tax time to work out things such as capital gains, dividend income, and more. At the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. So use that link. You can sign up to a free plan and track up to 10 holdings for as long as you want. Or you can sign up to a more premium plan for more premium features and reporting. And if you use our link, you'll get 4 months off an annual subscription. So go check it out. It's a great deal. And as always, thank you to those who have used our link, signing up to Sharesight, and is supporting what we do here.
Yeah, absolutely. Hamish, where do you want to start? I'll give you 3 options. We can talk about, we can get the sad stuff out of the way first and talk about inflation. You can go on a half an hour rant on Netflix, or I can go on a half an hour rant on Tesla.
Am I limited to half an hour?
Yes.
Is that really?
Yeah. Sorry, mate. Sorry.
No, I think let's get this UK inflation data kind of out of the way, and then we'll jump over to some earnings from Tesla, and then we'll jump into Netflix. I'll go through this relatively quickly. I mean, we get this data in every single month, and we get it for the US, Australia, UK, Eurozone. So there is kind of
lot.
We do tend to talk about inflation numbers a lot. So I'll go relatively quickly, but. Essentially, it continued to be unexpectedly high. The consumer price index rose by an annual rate of 10.1%, which was a decline from February, which was 10.4%, although it represents a very strong rate of inflation. And on a month-over-month basis, the rate was 0.8%, which annualized does still represent a 10% annual rate, which is obviously very, very fast. The ONS said the largest upward contributions to the annual CPI in March came from housing and household services, principally from electricity, gas, and other fuels, and food and non-alcoholic beverages.
Right.
Which is, exactly
Makes sense with what they're going through over in the UK. Yeah. That's, although hopefully, I'm trying to think about the weather patterns. It should be their winter should be almost over.
Yep.
Or not almost over, but getting there.
Yep.
So hopefully that helps them out a little bit.
Yep, definitely warmer weather coming for them.
On the horizon. But yeah, that is rough. I can't even remember what's Australia at? 7, 8?
No, I think
Australia,
well. I'm not actually sure. One of them was at 6.5, but I don't know if that was the US or if that was Australia. Maybe I can
continue to trend down, but Europe and the UK continue to get hit with pretty nasty inflation. They've just been. It's just so many compounding factors for them.
Yes.
Being particularly affected by the energy stuff with Russia, Ukraine as well. Yeah, that's a big hit.
Yeah, exactly. Yeah, you're exactly right. The supply side issues from the Russia conflict or the Russia-Ukraine conflict has been much more severe than in other places, much more of a direct impact from those supply chains being cut off. So as a result, you've kind of seen a little bit of a different approach from the government in terms of how to deal with this cost of living crisis. They're actually continuing to provide, or they have provided over the past year, 3,300 British pounds in basically stimulus, in relief. Right. And typically you would kind of think, well, providing more stimulus, giving people more money during the inflation crisis will just kind of fuel demand. Yeah. But the idea here is that considering that a lot of the inflation is from a supply shock from energy, that stimulus will not go into excess demand in the economy, but it'll just go to filling the gap on those energy payments. So
right, okay.
That's kind of the way that the government has been kind of dealing with the problem. And then on the other side, you have the Bank of England, the central bank, which is continuing to do the exact opposite of stimulus, raising interest rates. So it is kind of interesting. You kind of see a kind of a clashing of fiscal and monetary policy. One is tightening the economy and trying to reduce inflation, and the other one is kind of increasing spending, potentially increasing inflation.
But they're hoping the way they've structured it is that these stimulus payments don't actually add to demand. It's more just like they can just use it to save their bills, basically, or pay their bills. Yeah.
Yep, exactly right.
Yeah.
And then to kind of add to the all the negative news that's kind of going on out of the UK.
Just pile it on, Hamish.
I'll add one more on. Unfortunately, even though unemployment is still very low at 3.8%, it is on the rise, increasing 10 basis points in the December to February period. So the UK is very much facing the stagflationary issues that you've heard Ray Dalio talk a lot about. And his concerns have primarily been around the US, which is not yet facing stagflation, but the same kind of principles apply, that there has been this significant supply shock, which is kind of causing quite persistent inflation. And at the same time, the economy is weakening. So you've kind of got this difficult situation where both the government has to decide and the central bank have to decide, do we kind of increase the money supply, increase spending, which will maybe help people out in the short term, but fuel inflation, or do we tighten the economy, which adds to the already difficult situation they're in, but ultimately would help with inflation. So it is kind of stuck between a rock and a hard place.
Yeah.
Not a nice place to be.
Not something that I would like to make decisions about.
No. Yeah, I'm very glad I'm just observing the news and not the one standing up having to tell everybody.
How would you feel like actually being a Jerome Powell character and knowing that the decisions that I guess it's not just one person, like it's a group of people, but imagine just being on that committee, like, wow, the vote, what I say actually has the potential to affect millions and millions and millions of people. I couldn't handle the pressure, I don't think.
Yeah.
I don't know. I think I would have to really be confident in my understanding that I know what I'm doing is the best thing possible. So that'd be a very tough job.
Yeah. And it's incredibly tough because even if they have all the data available to them, it's still very difficult to know what is the right choice and what will have a negative or a positive impact, 6 months, 12 months down the road. So it is a very difficult situation. And unfortunately, the UK is kind of the poster child of all of the problems going on in the economy that are seen everywhere else, just to the full effect, unfortunately, in the UK.
Yeah, interesting. All right, is that what we've got to talk about?
That's the UK. Give us some good news. How's Tesla's earnings?
Tesla. Oh boy. No, Tesla's earnings were interestingly not great. We're so used to the narrative with Tesla just being like record quarter,
50% growth.
Yeah, record quarter. Yeah. It was very interesting that this was not a record quarter. And I actually didn't look at what the stock did after earnings.
I'll have a look while you talk.
You have a look. But I've been seeing through the media that they're copping a bit of a bashing, which is quite interesting because I thought that Tesla explained they provided a smart rationale for their results, which I don't know, maybe you just think, oh, they're just saying that to save face or whatever the cynic might say. But anyway, let's talk about it. Let's talk about what the hell's going on. So car deliveries, 422,000 in Q1 versus 405,000 in Q4 last year. And that was also compared to 343,000 in Q3. So that's steadily rising.
Still continue to rise.
Yeah. And that's the thing. They are pumping out these cars. The demand is there. They're selling a lot of cars, delivering a lot of cars. That's all great. Automotive revenue declined from 21.3 billion to 20 billion.
Right.
So that's from Q4 to Q1, quarter over quarter. But it was still up 18% year over year. And there is seasonality in automotive results. Q1 is traditionally the weak quarter for US auto sales. So that's people still didn't like it that auto revenue declined. Total revenue of 23.3 billion down from 24.3 billion. Again, still up 24% year over year though. So year over year, they're doing fine. They're continually growing, all that jazz. Just this quarter, it's been a bit of a whoop, down they go.
It's kind of an interesting situation because, typically most companies have seasonality. So you look year over year at the same comparable period.
Yeah.
But we also recognize that the economic issues, the higher interest rates, inflation has kind of accelerated, or the issues have kind of accelerated in the last 3 to 6 months.
Yep.
So you also do want to look at quarter over quarter to see if you're seeing any of that pain. So it is kind of an interesting situation. But clearly they've still, it's pretty impressive that they're still outperforming even the same period last year. I'm surprised given the fact that interest rates have gone up so much, and that does have such a dramatic impact on the auto industry where people are they're leasing, vehicles is a significant percentage.
And Elon was saying, look, people like to see Tesla as this golden company, but they're not immune to macroeconomic forces, and they have copped that a little bit. Interestingly, so that was their revenue numbers. Their operating expenditures were flat at 1.8 billion for the quarter, and their operating margin was down from, this is what everyone's like a little bit worried about, 16% down to 11.4%.
How dare they?
Yeah, exactly. So overall, their net income was 2.5 billion, down from 3.7 billion last quarter, and down 24% year over year. So net income was down year over year.
Interesting.
However, now you can say, Tesla, they had a shit quarter, macroeconomics bad. They did poorly. They did provide a pretty reasonable rationale as to why their results were like this. And they basically knew going in that their results were going to be like this because a part of their strategy was they reduced their prices on all their vehicles to spur demand. And I'll talk a little bit more about this in a little bit, but basically just their strategy is to continue to get as many cars out there as possible. Anyway, I'll read you what they put in their earnings release. They said, quote, "In the current macroeconomic environment, we see this year as a unique opportunity for Tesla, as many car makers are working through challenges with the unit economics of their EV programs. We aim to leverage our position as a cost leader. We are focused on rapidly growing production, investments in autonomy and vehicle software, and remaining on track with our growth investments." That makes sense. Our near-term pricing strategy considers a long-term view on per vehicle profitability, given the potential lifetime value of a Tesla vehicle through autonomy, supercharging, connectivity, and service. We expect that our product pricing will continue to evolve upwards or downwards depending on a number of factors. Essentially, if you read between the lines, this strategy is they know that their EV program runs profitably. And that's more than can be said for a lot of other EV programs from other manufacturers. So what they've done is they've said, okay, now that the macro is getting tough, people are saving that. They're not spending their money, they're saving it. Their cost of living's gone up, inflation's high. Other car makers are really struggling with their EV programs. Tesla, they're going to, take a little bit of a hit, but they're still going to try and get as many cars out there as possible, because what they see in the future is that those cars, if they're not making a heap of money off of them when they sell them, they will down the track through servicing, through charging, and most notably through autonomy. So that is their strategy, which they did make very clear. This is the first paragraph of their earnings release. And they said it multiple times through the conference call. I guess it just comes down to whether you believe Elon or not, whether you're just like a skeptic or whether you actually believe what they say. But to me, I don't know how you feel about this. To me, this strategy makes sense. Lower your prices. You can make heaps and heaps and heaps of cars. So instead of like doing a Ferrari where you just like don't make many cars and keep the price really high, just like get your cars out there, because you know that sometime in the future you'll probably be able to rake in a lot more revenue from each of those cars, even if you don't get it right now.
It is a kind of a unique situation, because you're right. There's so much potential additional revenue that can be generated from people who have Teslas. So that's potentially not even being thought about yet, just through kind of the software aspect of Tesla. And so, I mean, it makes sense to me. You're right. It does just come down to whether you believe them, or whether they are dropping prices because they're being crushed by kind of incoming competition, right? That would be like the devil's advocate, right? It's
for sure.
Are they doing it by choice? Are they choosing to make the product more attractive relative to competition, to hurt competition who are not profitable yet? Or are they doing it out of necessity? And that's really where the argument would lie ultimately. But it is if he's telling the truth, and it is the right strategy, especially when you have competition that are trying to. Demand is shifting quickly across to EVs, and they haven't figured out how to do it profitably yet. So now is the time to kind of put the foot on the neck. In a sense. It's kind of like if I mean, this isn't illegal, but this is a different industry. But where a local servo opens up across from a big Shell servo, you can't do this anymore. But they used to. Dramatically lower their prices and just wait until that servo went out of business and then raise their prices again. And in that industry, you can't do that. But that's basically, in effect, what you can do in other industries is, okay, well, we can just we can make our product far more attractive relative to competition. And if they can't get profitable, then they'll have to back away. And that's ultimately better for Tesla.
Yeah. Then the way I see it as well is another way of looking at it. You can put yourself in the mindset of General Motors, of another car manufacturer that has an unprofitable EV program. It's like right now with macro, killing everybody at the present time. It's like what are they thinking when they're looking at their EV programs that are costing them? Every car they sell, they lose money right now. Are they looking at that thinking, oh, we've got to get as many of these cars out there right now? No, they're not thinking that at all. No way. They sink their battleship. They're thinking right now, oh my gosh, maybe we should just chill. We're losing so much money on each of these cars. Maybe we just won't sell the EVs. We'll go back to the other stuff for a while. Whereas Tesla's just like, we can take a hit and we'll just sell hundreds and hundreds of thousands of cars. And, one day, not all people will upgrade to full self-driving, but some of them will. And when they do, we'll make bank. So it's kind of a long-term play.
Yeah. It will certainly be interesting to see how it plays out. I've said this the last couple of quarters for Tesla, and we haven't seen, there's a little bit of pain in Tesla's earnings so far, but we really haven't seen what I would expect to see, which is a kind of a dramatic drop off with all the other automakers, just because it is such a tough environment for an automaker. But the next couple of quarters and how this kind of plays out will be kind of interesting to see.
All right, I'm going to keep moving on. So other numbers that they note, capital expenditures rose from 1.8 billion to 2 billion, which combined with their lower operating cash flow gave them free cash flow of just 441 million versus 1.4 billion last quarter and 2.28 billion in Q1 of 2022. So free cash flow is just not it at the moment. In other news that I took out of the thing, out of the earnings release, battery storage deployed rose from 2.4 megawatt hours to 3.9 megawatt hours and was also up 360% year over year. And that's thanks to the ramp of their mega factory in Lathrop, I think is how you say it, in California. In terms of their gigafactories, so in the US, they just note the Model Y is the best-selling non-pickup vehicle in the US in Q1. We showcased 4680 cell production at our March 2023 Investor Day. Production rate continued to improve sequentially in Q1. Equipment installation for Cybertruck production at Gigafactory Texas continued in Q1 and remains on track. They're hoping to get the first deliveries at the end of Q3 this year, finally.
Wow, exciting.
In Shanghai, they basically said that Shanghai is maxed out. They're running at full capacity. Don't expect meaningful, significant increases in weekly production. And then in Europe, they say the Model Y production line in Germany has produced over 5,000 vehicles a week towards the end of Q1. So that's pretty cool. All progressing pretty nicely.
Yeah.
I'm just trying to think if I got anything else out of specifically the conference call. They just noted again that the Model Y was the best-selling vehicle in Europe in Q1, which is pretty cool. Model Y was the best-selling vehicle in the US in Q1, excluding pickups.
Wow. So, EV vehicle or just overall vehicle?
No, just best-selling vehicle.
Wow, that's actually insane.
Yeah. Well, Elon basically last year said next year, at some point next year, it will be the number one selling vehicle worldwide. Actually.
That's actually just crazy.
Yeah.
The past 4 or 5 years for Tesla has just been astronomical.
Yeah.
It's they're definitely not a small automaker anymore.
No. And it's so interesting. It's just such an interesting case, and I won't harp on about this because I'll go down a rabbit hole. But it's just such an interesting case of a company that puts all of their money and all of their effort into improving the product, as opposed to just having a mediocre product that sits among other products and then just advertising the hell out of it. Tesla still spent zero on advertising. They spend nothing. They've not spent a dime on advertising. And yet here they are. Anyway.
That's just such a good point, because especially if there is, and this happens over and over again in different industries where you have some kind of dramatic technological change, and especially if there's a lot of kind of cost barriers in the way of the legacy, the incumbents, in order for them to move into this new method of or this new product line. A new company that comes in with a management team that just cares about the customer and tries to put every dollar back in. We've seen it time and time again. It's very difficult for ultimately the legacy companies to make the transition.
They just get crushed. Okay, what else do I have to say, Hamish? They're creating test Cybertrucks at the moment, which is pretty cool. Elon called it a Hall of Famer product, a radical product. It's just not made the way that cars are normally made. So
Right.
that'll be interesting.
Wow. Interesting.
He's very bullish on this Cybertruck.
Yeah.
150 million miles is how far full self-driving beta has gone now.
Whoa.
That's a lot of miles. Elon just basically harping on about how it's obvious that the data advantage is just so strong with Tesla, full self-driving. What else? That's pretty much it. Nothing else really stood out. They note that they still have orders in excess of their production, which is good, but that is their strategy to adjust their pricing to make sure that they get, they can match deliveries to their production.
Yeah.
Tesla's also getting into mining and refining. Elon noting that they're not doing it because they want to. He noted to other entrepreneurs out there, stop making a photo sharing app and mine and refine minerals. And then Drew was like, yeah, and it's actually really fun. They're like trying to sell it. They said Tesla will have the most lithium refining capability in North America and probably more than everyone else combined.
Wow.
And it's funny that they're not doing it because they want to. They would love to just like palm it off to someone else. Like, oh, you mine and refine lithium, right? Yeah. Oh, sweet. Yeah, thank you. But they just can't find enough. So that's quite interesting.
It is funny that. I'd love to know a figure for just the total amount of money that has just been burned in Silicon Valley over the past 10 years. Like the amount of just small tech companies that don't make any money, they lived for a little bit and then died. Like it's got to be an enormous amount. It's got to be heaps, tens of billions, maybe even more than that in just money that just invested capital that was pulled from like big billionaires and 100 millionaires who invested a lot into venture capital and basically pulled money out of other investments and they've decided to invest in these small companies and it's just burned. It's just lit it on fire. I'd love to know that figure because it is crazy.
It'd be a lot. It's I like how Elon was specifically like, stop making a photo sharing app. Yeah. It's like, I wonder how many photo sharing apps have been made over like the past 5 to 10 years.
Yeah. And in the end, who's left?
Yeah, it's like
Meta.
Yeah, it's
and
like
Google.
2, 3 tops.
Meta and Alphabet still control the entire bloody market.
It's interesting.
Yeah. You asked how the stock performed. It was down 6% in after hours, 2% during the day. But if you compare to a month ago, it's actually quite flat. So, it's just kind of erased the gains of the last month or so.
Right. Okay. Interesting. That's all I had to say.
That's it.
Yeah, I didn't even go for half an hour, Hamish. Wow. Are you proud of me?
I am. Are you sure you don't have it? You sure you haven't missed a page? Hang on.
Yeah. Oh, I didn't. Oh, hang on. I didn't. No, I've got nothing.
Okay.
Now, so I'll start the stopwatch now.
Okay.
And we'll go for Netflix.
Maybe I'll surprise you. Maybe I'll pull a you and I'll do whatever you just did, 20 minutes.
15, 20.
We'll see. Like that. So Netflix reported their Q1 earnings, the first of the media companies to report, which for me is always something interesting to follow. I'm big into movies and television, and it's one of those industries similar to auto industry where it is undergoing a lot of change, right? So it's just interesting to follow what are the different strategies and that sort of thing. So
have you watched Beef?
I have.
Yeah.
Have you?
I'm not all the way through it. Did you like it?
It's so good.
Yeah.
I think that's probably the best thing I've seen this year. Oh, that and The Last of Us. Both of those are very, very good shows.
Yep.
Are you liking it?
I'm loving it, but I'm not. Does it have a good ending?
The ending's pretty good.
Pretty good. Okay, cool.
Yeah.
Nice.
I won't spoil
it.
No
spoilers. I'm just wondering.
And then they all die.
Classic.
No, but that's made by a small film studio called A24, and they come out with some incredible shows. Which is just a bit of a side note. But yes, Netflix's earnings revenue came in at $8.2 billion, which was up a measly 3.7% year over year. So how did they grow their revenue? Total subscribers is kind of one of the dimensions, rose 4% year over year. For the quarter, over the month, quarter over quarter, they gained 1.8 million net additions to reach 232.5 million subscribers, and that is compared to an increase of 0.5 million that they added in the same quarter last year. So Q1 is typically pretty light. A lot of content for Netflix and other studios comes out in the fourth quarter over the holiday period, and then there's kind of a lack of content during kind of the first quarter of the year. It's kind of similar to that on YouTube as well. You have like people cramming a lot of content into the fourth quarter for ad revenue.
True.
And then people taking off January. So there's not that much content, but kind of follows a similar pattern. So sub growth is, typically not that great, although certainly they're continuing to experience the, significant slowdown from just a couple of years ago.
Yeah. Do you happen to remember off the top of your head what their sub growth was last quarter? Or like
last quarter, as in the fourth quarter?
Yeah, fourth quarter.
Yeah, the fourth quarter was between 7 and 8 million additions. It was actually, I think, their third or fourth best quarter so far. But
I was just going to say, because I just look at, like, it's always the scrutinized number, but I'm looking at, they've got 232.5 million subscribers and they've added 1.8 million for the quarter.
Yeah.
I'm like, do people care about this? Like, seems pretty saturated. Like, why? I'm kind of surprised that there's still so much attention on how many new ads did you have? How many more subs did you add this time? You know, it kind of just seems like the focus shouldn't be on how many subscribers they're adding anymore.
I probably agree with that.
Yeah?
I think, if
like,
you
what's
look,
that in percentage terms? Like nothing.
It's not, right. And if you look globally, there's still a pretty significant opportunity to capture additional subs. So if you're looking globally, you're talking about 800 million to a billion households globally. Of course, a lot of those households wouldn't consider Netflix or they wouldn't consider paying for entertainment. So you got to factor that in. But you're right, like 232 million subs out of 800 million households, let's say globally, potential households once you take out internet and that sort of thing. Possible households with internet and that sort of thing. You're right. Like they're already, capturing a massive part. And especially if you look at, the scrutiny on their US and Canada subscribers is completely ridiculous because they're in every household basically once you take into account password sharing. But you wouldn't really expect there to be an enormous amount of growth out of sub numbers going forward. But in terms of by region,
this will give the answer.
Subs by region, the UCAN region, so US and Canada, subs were flat, and that's been the case for many quarters. It's kind of just hovered around the 75 million mark, and then they think they have 30 million in accounts that are using it but not paying, so it's over 100 million, and there's 110 million households, so they're basically in every household. In terms of their EMEA segment, Europe, Middle East, and Africa, they added 0.6 million subscribers. Latin American segment was minus 0.5 million, and then the APAC, Asia Pacific region was plus 1.5 million. Which
we're carrying.
We are. It's just us. It's definitely Australia and not the rest of Asia. But
no, it's just Aussies. It's just the Aussies.
It's just Aussies. But so the kind of the US segment has been not growing for a long time because they're kind of in every household. So really, the slowdown is their growth in international markets. It's why they're not capturing in Latin America and Asia anymore, even though they don't have much penetration. So that's kind of the subscriber side. Then you have the average revenue per member. Of course, they can, and that's the other lever they can pull, is to raise their prices or lower their prices. That actually declined 1% year over year. However, if you take out the foreign exchange impact, it increased 4%. So overall, if you remove FX, then revenue growth was 8% instead of 3.7%. So you can see that more than their revenue growth was cut in half, more than half, just by foreign exchange, which does really show you these international businesses that collect most of their revenue in foreign currencies. The impact is significant.
And if that's where all your growth is, then that's why
where all the growth is.
Bummer.
It's kind of crazy. It's like almost double-digit growth or 3% growth. It's kind of crazy.
That is a big difference. Very big.
In terms of incomes, so profits, operating income came in at 1.7 billion, which was down 14% year over year. Again, if you exclude foreign exchange, then profits were flat. So that's, most of the impact has kind of been on foreign exchange. They spoke a little bit more about their strategy to re-accelerate growth, which has kind of been their rhetoric for the last few quarters. They've got two focuses. One is on engagement and the other is monetization. So on engagement, they said kind of people are still spending 2 to 3 times as much time of their time on Netflix compared to the nearest streaming service, but they're still spending a small piece of overall viewing time. So the majority of viewing time is still on broadcast and cable television.
Yep.
So they've got to continually work to expand the different types of content that they offer.
Yep.
As people kind of move over from TV, there's a number of lines there that they can potentially capture. Reality TV and that sort of thing that's typically viewed on television, and as they capture those audiences. Mm-hmm. And then the other strategy is on monetization, which they've spoken a lot about, rolling out the account sharing restrictions. They're going to do more of that in Q2. Most countries will go through in Q2. They did a couple of testing in Q1. They did Canada, New Zealand, just the typical markets that they test.
Yep.
And then also interestingly, they actually did a number of price drops during the first quarter. They dropped prices in 116 countries, mostly APAC and Latin America. And this is essentially in order to drive more engagement. So they kind of spoke about how in the past they kind of had very uniform pricing, just similar pricing from place to place. Whereas now they're thinking a bit more critically about what prices work in different regions. Right. So for example, in India, they dropped prices pretty significantly, and it helped to drive overall revenue growth of 24%. So by dropping the price, they got a lot more interest.
Right.
Just because pricing is a lot more sensitive in India.
Yep. Can I use my VPN and pay a lower price? I'll just use my VPN, say I'm from India, and then I'll pay less for Netflix. That's how it works, right?
Yeah, that's exactly how it works. The Netflix investor in me is telling you, shut up. No. I genuinely don't know if you can do that because of where the payment comes from.
Yeah, no,
you can, of course, use a VPN to watch content that's in other regions. But I don't know if you could do that. That would be quite a strategy. You set up a bank account in India, register a business there.
I'd like to pay in Turkish lira.
Yeah.
Dear, oh dear.
No. So they kind of spoke about that. And then in terms of cash flow, they're now expecting $3.5 billion in free cash flow for the full year, which was an increase. They previously expected about $3 billion. And part of that is due to overall less expected content spend. In fact, total content spend is expected to be much closer to their required or maintenance level this year, which is a bit of a change from the past where they would normally spend far more than their maintenance amount so that they'd spend how much they need to maintain the platform, and then they'd spend even more to try and capture in these international markets. But what they're noticing is that at the moment, especially in some of these international markets where there's a lot of inflation and economic problems, the additional money they're spending on content just isn't gaining subscribers. Okay. So at least for this year, and then they'll reignite it next year, they're kind of cutting back some of that growth expenditure that they would normally spend in some of these places.
Right, okay.
And at the same time, they're kind of doing some of the things I spoke about. So reducing prices, introducing the ad-supported tier, getting the more price-sensitive offerings in place, and then they can reignite spend and try and go after those customers once those kind of new systems are in place.
That makes sense.
Yeah. So interesting to watch because, as I said, it's a company that's, facing, I would say, probably a combination of increased competition in recently, macro problems because most of the growth is in countries that are, have rampant inflation or are already in recession. A lot of European countries, for example, Eastern European countries. So it is interesting to see how they navigate some of those issues.
Yeah. There you go. Anything else on Netflix? Yeah,
I just as kind of a related story. This actually was from, I think, last week, but we didn't talk about it, which is, related in terms of the media space. HBO Max has changed its name We first spoke about this a while ago when it
that's
was there was rumors that they were going to change it to Max, and I said that's the worst name they've ever come up with. And
It's like the Pepsi, isn't it?
yeah, oh, Pepsi's streaming service is now out. And of course they listened to me and they didn't call it Max. They said, Hamish, you're right. That's a terrible name. HBO
Wait,
is the brand. No, they called it Max.
Oh, okay. I was like, what? That's not what it says here.
No, they called it Max,
Right.
which I hate it. I thought, and they changed it.
Maximilian.
I don't like it. It's just such a flat name.
Yeah.
You Google Max and the streaming service doesn't come up.
Yeah.
Because you're searching Max.
Yeah. Yeah. Exactly. No, exactly right.
I don't know.
It's like you think, I don't know, Uber. I mean,
Yeah.
no one, it's so iconic. Everybody knows. What are some other examples? I can't even think of any examples off the top of my head. But that's just like branding 101 is make it original at least.
Yeah. I'm not sure about the decision, but we'll see how it plays out. So, of course, what I'm talking about is Warner Brothers Discovery is the company. They unveiled their new streaming service, which combines HBO Max and Discovery Plus, which is their two services. So HBO Max has always had their kind of high production film and television.
Yeah.
And then Discovery Plus has had more of the lower budget, more stuff that goes out on their television network. So reality TV and documentaries and that sort of thing. So now kind of combining the infrequent high quality production with, the regular content that, keeps people on the platform essentially. And the combined service pretty much looks very much like Netflix now, right? Because you have a much more wider array of content genres like Netflix does. They have the kind of their high budget stuff, but also a lot of reality TV and game shows and that sort of thing. And they also have pretty much the same pricing now. The cheapest plan for Max is $9.99. These are US prices, but $9.99 for the ad-supported tier versus Netflix's $6.99 for the ad-supported tier. So actually more expensive on the bottom end. But on the top end, both are $19.99 for the 4K, no ads, 4 screens. So they've basically... really in a sense they've created a product that now obviously the content is different, but the types of genres they offer and the price points is all very, very similar to Netflix, which is interesting to see. And I don't know, at first I thought this wasn't going to be a good idea, but on second thoughts, I think it does make sense for them to do this, especially when you think about when you think about their service from a churn perspective, that having a low churn rate, people not canceling frequently is so important, because if people cancel a lot, they have to spend so much more on marketing just to get them back. Right. Like if there's, if I don't have HBO Max when The Last of Us comes out, they have to market at me to get me on the platform to watch it. Whereas if I'm already on the platform, I'll be browsing around and I'll just see it natively. So there is a significant increase in marketing and other related costs that comes with having a high churn rate. And that's been an issue for Warner Brothers since they launched their streaming services. So that'll probably help to reduce that, having, consistent, lower quality TV just there for people, to give people a reason to regularly subscribe.
Yeah, interesting.
Yeah.
Makes sense.
Yeah.
I don't know if I can add anything onto that.
Yeah, that's pretty much it. We have, Warner Brothers and Disney and Paramount will report their earnings over the next few weeks. And that I'm very curious to see how their growth is going, because for a couple of those companies, their US growth had also kind of stalled to a halt. So it'd be interesting to see if, some of these things can help reignite some growth for them as well.
Yeah, for sure. Oh, very good. All right. Where shall? Oh, hang on. What was the time there? How? Oh, I didn't even take note of when you started speaking.
I think it was
15 minutes.
Yeah, I think about just under 15 minutes.
All right, I'll give you 15 minutes. Well done, mate.
Yeah, I've done well.
You pat yourself on the back. That's amazing. Should we talk about Apple?
Yeah, what's happening with Apple?
Tim Cook flew over to India and opened the first 2 Apple stores in India.
Wow.
So it's pretty interesting. I'll read you what CNBC wrote about it. Apple CEO Tim Cook is in India this week. He's opened 2 new Apple stores, is scheduled to meet with Prime Minister Narendra Modi, and he's seeing sites and visiting customers in the country. The international trip is the strongest sign yet that India has become a huge strategic focus for Apple as supply chains move away from China and its smartphone and its smartphone market is increasingly saturated with iPhone users. Quote, I'm very bullish on India, Cook said during a February earnings call covering Apple's results for the December quarter, when the tech giant observed record iPhone revenues in India. Apple is, quote, putting a significant amount of energy in India, Cook stressed at the time. India could echo the role that China has played in Apple's business over the last 15 years, a massive market with an expanding middle class to power sales growth and potentially a home base for the production of millions of Apple devices.
Interesting. So it's interesting that it's from like both sides, not just from the consumer market, but from the production side as well, potentially looking for a country that maybe gives them more favorable production deals and relations.
And a little bit of diversification away from China.
The geopolitical risks.
Whether you believe that goes anywhere or not, I kind of sit in the camp that nothing's probably going to come of it. But, you know, it's diversification nonetheless. There's room for Apple to grow on the subcontinent. Apple has less than 5% of the smartphone market share in India versus about 18% in China, said Angelo Zeno, senior analyst at CFRA Research. The opportunity could be massive. Apple did $74 billion worth of sales in China, Hong Kong, and Taiwan in fiscal 2022. That's about 18% of Apple's total revenue during the period. Corporate filings in India covered by local media suggest that Apple's sales in the country were about $4 billion in fiscal 2022. And Bloomberg reported earlier this week that Apple reported nearly $6 billion in sales in the year ending in March. So there's a big discrepancy. But if India, for the next 15 years, could be like what China has been over the last 15 years for Apple, wowee. Yeah. That's obviously, it's clearly a smart experiment, at least, even if it doesn't play out. Yeah. It's a smart thing to try to get some Apple stores up in India and also shift your production there. The article's very interesting. It notes that Android has over 95% of market share in the country, according to StatCounter.
Yeah, wow. Yeah, that's crazy. And I mean, in a sense, it kind of makes sense because Apple historically has been this kind of flagship premium product, and they have enormous market share in the US because of that. But yeah, it makes sense. I mean, you have companies like Samsung, which use Android operating systems, and they're not just making the flagship products; they're making a wide variety, all the way down to a couple $100s. So it makes sense that Android, as a result, whichever phone maker it is able to capture such a large market. But yeah, and then you see kind of Apple more recently has been introducing those lower price point Apple products. And, part of that, I'm sure, is their intention to enter some of these markets like India, where there's a lot lower, household income per capita or household income or GDP per capita. And of course, that is growing rapidly, but they need to kind of have these lower price points to kind of get big market share in those areas.
You've absolutely hit the nail on the head with that.
Did I?
Yep.
Did I steal your next point?
No. I'm just reading the article here. They say that the main, this is talking about why Android has 95% market share. The main reason is price. Most phones sold in India are priced below even the least expensive new Apple iPhone.
Wow. Yeah.
Yeah. Industry analyst IDC estimated in February that the average selling price of a smartphone in India is $224.
Wow.
Which had increased 18% in 2022. Apple's entry-level phone, the iPhone SE, retails for $429 in the US.
Yeah, and even that price point is a lot lower than their normal pricing.
Yep.
I think at the top end you have $1,400 US.
$1,000 phones.
$1,000 is kind of their base of the premium. So yeah, even $400 is a big drop for Apple in terms of where their price point is normally. So it is that's a crazy stat, $224 per phone, which is that's a lot lower than I'm sure what the average is in the US, for example.
Yeah. Tim Cook's answer, financing.
Yeah,
that's actually what the article says.
Wait.
One way for Apple to address this gap is by allowing customers to pay for their phones in installments or giving them a discount for trading in an older device. Cook mentioned these strategies when he was asked about India in February.
Interesting.
Quote, there's been a lot done from financing options and trade-ins to make products more affordable. They're not making them more affordable. We're just going to give you an easier way to finance
Actually, less affordable. I mean,
less.
You pay interest.
So
That is
true.
interesting. I mean, Apple recently has been making a lot of moves in payments and finance. I'm not sure if you saw it. Just a couple of weeks ago, they launched a new interest savings account with 4% interest or something from Apple, backed by Goldman
Wow.
Sachs. So yeah, and you have the Apple card, the rewards card,
Yep.
now they're offering financing. So it is interesting to see Apple with their huge amount of just capital base that they have to enter some of these interesting markets that you wouldn't expect a phone manufacturer to be offering a savings account to be a financial institution.
Yeah, I reckon.
Yeah.
Quite bizarre. It'll be pretty soon. Apple will just be an everything company.
Yes.
You just literally do whatever you want.
Yeah.
Okay, I quickly want to talk about the other half of the strategy. So that's talking about Apple's challenge and trying to sell more phones in that market. But the other half of the strategy is manufacturing. So it says here, nearly all iPhones are currently assembled in China, which has caused some problems over the past 5 years, starting with trade tensions and possible tariffs during the Trump administration and extending to more recent supply chain disruptions caused by COVID and China's COVID policies, which led to sales shortfalls. India could end up being a big winner as Apple looks for a non-Chinese manufacturing option. In January, India's commerce minister told CNBC that Apple was manufacturing its latest iPhone 14 in the country and had a goal to produce as many as 25% of all iPhones in the country.
Wow.
That's quite significant, isn't it?
Yeah.
Apple's primary manufacturing partner, Foxconn, which oversees a large portion of assembly of new iPhones in China, is expanding in India too, reportedly building a $700 million plant for iPhone parts in Bangalore.
Right.
In another parallel to China, the Indian government is eager to embrace Apple to use it as a symbol to attract other high-tech firms to the country for manufacturing and development. For the past 20 years, Chinese governments at multiple levels have worked to make massive factories like Foxconn's factory in China, known as iPhone City, possible. Apple's long-term strategy in India is best summarized by a quote Cook gave to local media during his 2016 trip to the subcontinent. Quote, we are putting enormous energy in here, and we are not here for a quarter or 2 quarters or the next quarter or the next year or the next year. We are here for 1,000 years.
1,000 years. That's quite ambitious. Could you imagine 1,000 years from now? Yep, the oldest company.
Can you imagine like someone hopping on the earnings call and just being like, Tim, thanks for taking the time today. Look, I was just wondering, can you give on your 1,000-year guidance? What do you think revenue will be in 1,000 years?
1,000 years, yeah, it's quite an ambition.
It's like one iPhone will cost, like just the base iPhone will cost like $25 trillion.
Yeah,
in 1,000 years.
Yeah, something ridiculous.
It's probably more. I don't even know.
That makes you think. Like, it's kind of crazy. Like, our generation now, if we look back 1,000 years, there's really no evidence of it. Like, we can't talk to the people. We don't know. There's no video of them, for example.
Yep.
Whereas in 1,000 years, there will be people, not looking back on this, I'm sure, but this might be gone, but looking back on film from this time, which is kind of a crazy thing to think that there could be someone out there just watching this being like, wow, look at that microphone. Like, it's not in their head.
Yeah, exactly. It is very interesting. Yeah, because like, when we look at 4K video, even 1080p video, it's very clear. You can get a very good idea of what life is like and how people. Yeah, it's a very good point. Yeah. Is that they will be able to look back, but
or maybe it'll all be gone in a nuclear wasteland in 1,000
maybe.
I like to be an optimist, so I'm gonna go with.
There'll be some like historian that'll chuck on the Young Investors podcast. I like these guys.
Personal finance back in the 21st century.
I wonder what the S&P 500's at.
I don't know why they all sound old in the future. They probably sound younger. They're probably get anti-aging.
They could probably barely understand what we're saying.
Yeah.
Old English.
Yeah. Jeez.
They're so professional back then.
Wait, and hang on, this is their job.
Yeah. What, they had to work? Are you kidding?
Wait, these humans have freedom? They're not controlled by AI? No.
Oh dear.
No, sorry to derail that. Yeah.
Yeah.
No, very interesting. And also, I guess, not super surprising. I mean, big multinational corporations will always look for ways to diversify manufacturing and look for ultimately the cheapest and most reliable manufacturing options. So it makes perfect sense. Yeah.
Do we have anything else to talk about today, or is that just about it?
I think
That's
just about it. We can
do a couple questions.
we do have a bunch of questions to answer from you guys, but as always, we're always welcoming new questions. So as I said at the beginning, if you're on Spotify, just scroll up and ask your questions in Spotify, or head over to the YouTube version over to ask your questions as a comment. I'll ask this first one to you. Hey guys, thank you for the podcast. Where can I find the whole Warren Buffett interview, which is what we were talking about last week? Yeah,
It's CNBC Pro, isn't it?
it is. So unfortunately,
Paywall.
unfortunately, it's not one that's just gone up on YouTube. Sometimes, the Daily Journal meeting is just on YouTube, for example, and the Berkshire annual meeting is also it goes on YouTube. But no, this one's paywalled. So unfortunately, we can't give it to you.
We'd get copyright flagged.
I'm
for
pretty
sure.
sure we would get a knock on the door.
Oh yeah. We were even debating whether we could be in trouble just using clips from that CNBC interview because it is behind a paywall. I'm pretty sure the head honchos at CNBC, they just don't care if YouTubers or other media uses clips from just their programming. But I think it's a bit more gray,
It's a gray area.
when it's behind a paywall, and they actually every view that they get on that is somebody that's a paid subscriber. So
it's definitely a gray area because you definitely have YouTube channels who react to or give commentary on movies, for example, which they're all paywalled, right?
Yep.
But even that is a gray area of, well, is that transformative? Are they creating something new from it? Or can you just not show clips and break down a movie, for example? It's not your work kind of thing. So it is a gray area, but yes, CNBC Pro.
Welcome to the world of IP and copyright and who owns what and what's transformative and what's not, and it's a mess.
It's a whole thing.
It's a whole thing.
Yeah,
it's a whole thing.
Yeah. But with that said, so I've ripped the whole interview and it's in a Google Drive link at the it's not.
Link in the description. Oh gosh. Oh, I'm not following any Google Drive link from you, buddy.
Jeez.
All right. Should we do this next one?
Yeah.
This is an interesting one. It's kind of a bit subjective depending on who you are as an investor. What kind of management compensation package is, in your opinion, in a gray area? I'm looking at a company where only 40% of the compensation is performance-based, and I feel like that's maybe too little.
Yeah.
I don't know if I have any necessary rules around how much needs to be stock, having a stake in the company, how much performance-based, how much salary.
Yeah.
Do you have any specific rules, or you just it's a case-by-case basis, I feel like?
It is case by case, and I don't think there's any one factor that should be an immediate yes or an immediate no necessarily. It's kind of like you're looking at a number of different things within compensation and management ownership. And then it's kind of a matter of, is there a lot of negatives or a lot of positives?
Yeah.
So you're right. I think 40% of compensation tied to performance leans on the negative side. But that alone, there's nothing I could read into that in isolation because there's so many other factors. So, for example, like you mentioned, how much stock does the management team own? And are they actively purchasing more stock regularly, showing... and is a large part of their personal ownership, personal wealth invested in the company, or is it just a small part of their wealth and they have large investments in other areas?
Generally, why founders are so good.
Exactly right. Generally, they have a lot of stock and they own a large. Most of their net worth is usually in the company.
Yep.
And then in terms of compensation, there's a performance-based compensation. There's a lot of different ways that. A lot of different targets that can be used for measuring how variable compensation is paid out.
Yeah.
So, some companies will use numbers that are misleading and adjusted, and other companies will
Earnings
focus
per
on
share.
and other companies will focus on things that matter to us. Like to me, I care a lot about return on invested capital. How effective is management? Right? It's all good and well that revenue went up that year, maybe even profits went up. But if they're not doing it effectively, if they're wasting money in the company, then that's bad. So it's something I would look for. But
or they can do it on like total shareholder return or something like that.
Yeah. Yep.
But yeah, it is a bit hit and miss because you can see like a heap of performance based compensation. So they hit business KPIs which make the business better, and they get paid a boatload of stock, or they just get straight cash. But you're right, accounting, it can be messed with. So earnings per share can be messed with. They could just put through a massive share buyback program and reduce the number of shares outstanding, and then that props up the earnings per share number and they get a big bonus. Whereas maybe that's not the best use of their money to do a big buyback. Maybe their stock's expensive or something like that. So it is case by case, salary, performance based, stock ownership, stock options. I don't think you can, you can even say like, you can try and say like ownership of a lot of stock, that's good. But then again, you could say like ownership of a lot of stock options, that's good. Oh no, that can also be bad. Yeah. So it really is a case by case basis. I think you have to just, you just have to try it. I wish there could be like a easy way, easy rule to follow, but there's just not, I guess.
I think one other thing I'd add as well is some companies you'll notice that they change the methods of and the rules in their compensation plan all the time. Like you'll see they'll change every 2 years. They're tracking different things. They're getting paid different amounts. Whereas other companies, it'll just be very consistent. They always follow revenue. They always follow earnings per share or free cash flow, whatever it is. And it's pretty consistent regardless of the changes in management. And then other companies, you'll see it chop and changes all the time. One year it's total shareholder return. The other year it's this and that. And that to me is a bit of a red flag of them just changing the compensation plan to fit the current operating environment, which tends to happen quite a lot. So just that's something but again, that's one factor in a basket of factors. So it's a bit muddling.
In a basket of factors, in a basket of factors, in a basket of factors.
And admittedly, I think management is probably the area I know the least about in terms of how to assess them. It is very complex. Especially, I think something Monish said, which was interesting, was his experience as running a company with a lot of employees gives him a lot of insight into management. That's something that I personally don't have.
Yeah.
So
makes sense.
There is an element of that too.
Yeah. All right, cool. Let's wrap things up.
Yeah.
Thanks for having me over, Hamish. Much appreciated.
Well, you kept knocking on
the
door.
I just
you wouldn't let me.
Hamish.
No,
it was good.
Yeah, it's great to have you here as always, and thanks everyone for tuning in as always. As I said, leave your questions, YouTube, Spotify, and we'll be back next week
with a big announcement.
With this is the announcement of the announcement next week.
And then we'll clickbait the thumbnail.
The announcement that everyone knows.
Huge announcement of the announcement.
Yeah. Of an announcement that everyone knows is coming.
Yeah, everybody knows. You can figure it out. But we'll talk to you more about it next week.
Yes.
But yes, with that said, nice meeting you all. And we'll talk to you next week.
See you guys.
Bye-bye.